PE ratio is short for the ratio of company's market price per share to its earning per share. Theoretically, a stock's PE tells us how much investors are willing to pay per rupee of earnings. It indicates the payback period to the investors or prospective investors. In other words, PE shows us as to the investment in market price will be recovered in how many number of years. However, this is a far too simplistic way of viewing PE because such interpretation fails to take into account the company's growth prospects. A better interpretation of PE ratio is to see it as a reflection of market's optimism concerning the firm's growth prospects. High growth shares have high PE ratios as investors are willing to pay greater multiple of earnings of company to achieve higher future growth. If high risk is found in a share, it reduces the market price, thus reducing the PE ratio. In other words, the stock PE ratio is having an inverse relationship with the risk factor. This ratio helps the shareholders to decide whether the shares should be purchased or not in a company. Most of the time, the PE ratio is computed using EPS from the last 4 quarters. This is known as the trailing 12 months or TTM PE ratio. However, occasionally EPS figures come from estimated earnings expected over the next 4 quarters. This is also known as leading or forward or projected PE ratio. A third variation is, however, sometimes taken into consideration, which takes the past 2 quarters and the next 2 quarters. Here, the last 2 calculations are based on analysts' estimates that are not always perfect or precise.